As we know that the new partner, once become the partner of the firm, will get a right in the assets of the firm. Certainly, the old partners cannot allow him to become the owner of the assets of the firm without getting some payment. And for this, the new partner pays capital to the firm. The new partner can bring capital in the form of cash, in the form of assets, or mix of both. So the entry will be bank account debited to sundry assets account debited to capital account. Whenever a new partner joins the firm, he gets some share of profit in the firm, and certainly the old partners will not sacrifice their share for no compensation. Actually, old partners sell their share of profit to the new partner, or in other words, new partner purchases his share of profit from the old partners. For this purpose, the new partner brings some amount which is known as goodwill. So today we are going to discuss accounting treatment of goodwill on admission of a partner. The different aspects are here. The very first thing, if at the time of admission of a partner, if there is some old goodwill exist in the firm, that must be written off. The treatment is old partner's capital account debited in old ratio and goodwill account will be credited. Now, second point, suppose the new partner brings the amount of goodwill privately. Privately here means that the amount of goodwill is given to old partners by the new partner outside the business. It means that the amount of goodwill is not brought into the firm. When the amount of goodwill is not brought into the firm, certainly no entry is required. The third one, when new partner brings his share of goodwill in cash, the first entry will be bank account debited to premium for goodwill account. The second entry will be premium for goodwill account debited to old partners capital account. The old partners, here I am taking A and B, so A and B will be credited in their sacrificing ratio. Remember, if only one partner is sacrificing, the whole partner will be credited to one partner only. If any one partner is gaining, then certainly his capital account will be debited. We will discuss these things with the related questions. Now, A and B, if they wish, can withdraw the amount of premium for goodwill credited to their account. If they do so, then the entry will be A's capital account debit, B's capital account debited to bank account. Sometimes new partner brings the amount of goodwill in some kind. In some kind here means that new partner brings his share of goodwill in the form of some assets. So these assets will be debited instead of bank account and premium for goodwill account will be credited. The next entry will be same. The premium for goodwill will be credited to old partners in sacrificing ratio. The withdrawal entry is not possible in this case because the new partner has not brought goodwill in cash. So when the goodwill is not brought in cash, it cannot be withdrawn in cash. The next one is mix of cash and kind. Suppose the new partner is bringing a share of goodwill in the form of cash as well as in the form of some assets. So it is just the mixture of case number 3 and 4. There is no new thing in it except that the withdrawal will be possible only up to that part which is brought in cash. Suppose the new partner has not brought goodwill. In that case, new partner's current account will be debited and old partner's capital account will be credited. The purpose of debiting new partner's current account is that whenever the new partner brings his share of goodwill, his current account will be closed. Sometimes the amount of goodwill is not mentioned in the question. However, some clues were given through which we have to calculate the goodwill. This is known as case of hidden goodwill. For calculating the amount of hidden goodwill, first of all, we will calculate the required capital of the firm on the basis of new partner's capital and reciprocal of his share. Suppose C is the new partner and he is joining the firm for 1/4 share. So his reciprocal share will be 4 by 1. In this way we calculate the desired capital. The desired capital means the capital which should be there in the business. The next step is calculate the actual capital. For actual capital, we use the capital of old partners plus capital of new partners plus all accumulated profits, and if there are accumulated losses will be subtracted, profit on revaluation will be added, and if there is a loss on revaluation will be subtracted. The third step is from the desired capital, the actual capital will be subtracted. Remember, if desired capital is greater than actual capital, only there is a value of goodwill. The next step is calculate C's share of goodwill from the value of goodwill of the firm. And in case the new partner never brings goodwill in cash, so the entry will be same as new partner has not brought goodwill in cash. C's current account debited to his capital to B's capital in sacrificing ratio. Thank you.